Hey, hey, Russ, can you hear me?
I hear you.
All right, perfect. We are live. I ladies and gentlemen, I'm having some technical difficulties and it's thrown me off a little bit. I will say I'm a little frustrated today, Russ. Just because I typically come on, excuse me, and we go right into a little clip with some music to introduce me. But as I was telling you, my kids, for some reason today, we were supposed to get 20 inches of snow, I think. So the schools got canceled. So we're all in here today using up all the bandwidth, and I can't tell them to get off the computer because Dad is doing something. So here we are. Welcome.
Thank you. Appreciate you having me on.
Oh, no worries. And so this is called Lending with Purpose, and it's conversations that we have with clients and friends and intros to various forms of information, professionals and resources that we use, like yourself, and things that we wanted to that we never knew existed or wanted to learn more about. So, ladies and gentlemen, I have Mr. Russell Brown here with us today, and he's a real estate investor and realtor in the Washington D.C. area, and we're all in for a treat. Today, we're going to be talking about finding the right property for an investor. Is that right? That's what we're going to do, like how to identify the right property.
Yeah, pretty much. We're gonna do the levels of that. So yeah.
Awesome, awesome. So Russ, before we get started, tell us who you are and what you do, and then we'll get into it.
So my name is Russ Brown, and let's see. I always tell people I started investing in real estate back in 2010, but that's actually when I got my first property. I actually started in 2008. It took me. It was toward the end of 2008. It took me a whole year before I was able to get my first property, and I was pretty frustrated and mad about that at the time. But now I realized that was really a blessing. I mean, I learned a lot in that one year. I was trying to go after short sales, being a novice, not knowing what I was doing. And by the time I actually was able to get something, the whole Washington, D.C., well, actually the whole country's real estate market had kind of collapsed. But as most people know, DC doesn't really collapse, but in relative terms, DC collapsed. And by the time I was actually able to get my first property, it was perfect timing, 2010. And pretty much been doing a buy and hold since then. I specialize in the voucher program. That's really where I decided I was going to have my niche. And then after that, I started doing flips. And after that, I became a realtor to sell my own stuff. And then I realized, damn, I'm good at this. And I really created it into a real business. And now I just do all three.
That's awesome. Yeah, you are good at it, man. So you came out of the gates as a how long have you been like I know you've been a realtor for a while, but like really committed to selling real estate, like as a realtor.
Uh, Only since really 2019, to be honest with you. Into 2018, 2019, because I got only reason I really got my license, which was in 2016, is because my best friend's grandma had these two houses side by side in Columbia Heights, and she asked me. She knew I did real estate because I used to come over there and help her out, little plumbing stuff, whatever she needed. I would help her out. And people used to knock on her door like crazy because in Columbia Heights, all the houses are really expensive and kind of really turned into condos, high level. And then you would see these two houses, and they were obvious that nobody had touched them in over 100 years, which was the case. And so everybody was trying to get her to sell it. I mean, sign up to sell it to them or be a realtor. And she decided to finally sell it, and she told me, she's like, I need you to sell it. But she just knew I did real estate, and so I was like, all right, cool. And so I had to hurry up and get my license. Like in 30 days, I had to get like that fast. And so I just got it for that. But I wasn't really planning on doing a whole lot with it besides sell my own properties on it. And then one year I looked up, and 20 beginning of 2018, I looked at my P&L, and I had done like $65,000 in commissions that year without even trying. So I was like, wait a minute, am I missing the boat or something here? So after that, I decided to really focus on it.
Understood. And then what, like in regards to, so like what we're going to be talking about today is like how to identify the right property. And I know largely you, because of the fact that you are a real estate investor and that's how you started off, like, what does that really mean to people? I come to you and we have a conversation about it. Like, what does that piece mean? Like finding the right property.
So a lot of times people will come to me and say, "Hey, I want to invest. I want to, do a flip or buy and hold." And um, one thing that the place I always want them to start at is what kind of return do you want to make? Because basically I need to work backwards. I can find anybody a flip or a rental, but you got to have kind of be disciplined about it. Just like I don't know if you're a poker player or a gambler, you got to have your disciplines. Say, if I get this, then this is what's going to happen next, you know? And so I like to work backwards from there because I know that you can pretty much take your money and invest it in the stock market and make at least probably 8 or 9%, if not more. So if you're okay with making 4 or 5% on a rental property, just let me know that. It makes my job easy. But most people want to try to either tie that number or beat that number if it's not something they're going to be living in. And so I usually ask them, what is your return on investment that you would like to have? What's the return rate? And so once they give me that, then I can say, okay, well, let me look and see what we have in the inventory and how you can actually accomplish that with what's out there right now.
Understood. So your very first question is what return?
Yeah,
What's the return on investment that that you would like to have?
exactly.
And how do you, so what if I could, I give you a number and like, how do I know what's, you know, what's attainable or not? Like, what if my number is, I tell you 20%, but you and I both know that potentially maybe that's far fetched. Or what if I say a certain number that doesn't really agree with the market? Like,
Right.
how do you let me know that? Like,
I would tell you that. I mean, so especially so if you told me 20%, I would ask you what's your budget because you can actually attain 20% in DC, but you got to be playing in a space that not everybody else is playing in because there's a lot of money here in DC. I mean, if you think about it, if you think about money in a city, you normally think about okay, somebody, an attorney, a big time attorney, or something like that. But all it really takes is two government employees who've been there for probably 10 years, who are on a G14 or G13 salary. Put those two salaries together, and they can afford over $1 million house. I mean, way more than $1 million house, actually, probably like 1.5 or so. Considering other things, but and so that really kind of like pushes up the what's affordable here. And so those are the people you're competing with. So if you're telling me that you have $50,000 to play with or $40,000 to play with, and you want 20% return, I'm going to say, all right, this is probably not the market for you, and I'm probably going to point them a little bit more towards Baltimore or other markets where because there's an inverse relationship. This is going to sound a little confusing, but there's an inverse relationship between high appreciation rates of property and cash flow. So if you're in DC, there's high appreciation rate. I mean, we're talking, year over year, 16% growth. Sometimes, a lot of times, last year I was over 10% growth. So if you have a $100,000 property, you got by the next year is worth $110,000 or $116,000. You're making money off of that appreciation. So therefore, the person who sells you that property, they know that you're going to make that money off the appreciation. So they know that they don't have to give you as much of a cash flow on that property. They say, hey, make your money on the appreciation. So it's going to be an inverse relationship. If you're more so concerned about the cash flow, then you would go to somewhere like Baltimore, where you can make a high return on your money right away from just the rents. But the appreciation in 5 or 6 years, you might see that your property value only went up 10% over 10 years or 5 years. So that's the tricky part. So yeah, I would tell them either, hey, go to this market, or if it's something really out of my, I don't think is feasible, I just tell them I don't think it's doable. I mean, I'll look, but I'm not going to put a huge effort into looking for this unicorn.
the unicorn, right? Yeah, the unicorn. So what do you like? Like, perfect world. Like, what's good for you?
I mean, if we can go back to 2010 price, I mean, it wasn't good for everybody else, but I mean, it was great for me back to 2010, where I was buying 4 units for $125,000. Yeah, and still renting them out for $6,000. I mean, if we can go back to that, that'd be great. Uh, I am right now. I am experimenting with trying to recreate what I did in DC and Baltimore. So in DC, I have the whole infrastructure set up. I have my own construction crew. I'm very well versed in the voucher program. I was the chairman of the Landlords Association for the Housing Authority for 3 years. So it was my job to really know that program because I helped other landlords in the city navigate through it. And so that's really like my bread and butter, is the voucher program. That's what I love. And so right now I'm trying to recreate that into Baltimore. I'm doing it slowly because back in 2013, 2014, I decided I was going to recreate what I did in DC and Chicago because that's where my parents were from. And that ended horribly, horribly. So I call that my tuition. I learned a lot from that. I left a
I
lot.
heard Chicago was a market similar to Baltimore.
It is, and I didn't know it. Because
Ah,
when I bought my first properties in DC, you know, not realizing that almost anybody's going to look like a genius who bought in 2010 and still held on to it in 2013. I felt like I was a real estate genius. I was like, oh, everything I'm doing is gold. I can't miss. And so every time I would go to Chicago, I would see these big empty buildings, and I was like, well, I know how to do this. I could take this. I bought an 8 unit building. I bought an 8 unit building in Chicago, 6 car garage, brick, really nice area, and for 95 grand. Like the wholesaler brought it to me. I was like, I don't even need a home inspection. I was like, I'll take it for sure. And yeah, I was like, I can't lose in this one, and I lost.
right, because you're looking at it like it's this market, and you're looking at the price at 95,000. So it's like, but then again, you're not thinking about potentially the cost to upgrade it, right, or to fix it up. But then the appreciation rate likely got you, I'm sure, right, because the home values weren't appreciating like a $95,000
I didn't even get that far, to be
unit
honest.
building should be, right?
Yeah, well, I didn't even get that far. What
Right.
happened to me is that I didn't have my infrastructure set up in Chicago. Like all my infrastructure was here, so I had to go through the phone book, call people, ask for contractors, interviewing architects, and basically I was starting from scratch, almost like a newbie, and what wound up happening is in Chicago, the laws are so much different than here, and the rules were so much different than here. I had a back porch, and we call them fire escapes. They had a back porch on there. I didn't know that in Chicago, that's the thing they scrutinized the most heaviest because some people had a house party, 25 people, they collapsed, the back porch collapsed, and 25 people died. And ever since then, like that, they are on you about these back porches. And so that was $35,000 I hadn't budgeted. They told me I could only use copper. I didn't know that, because here in DC you can use copper, PVC. And then the most important thing that made me kind of know that I made a mistake is that these were all 4 bedroom units. And I was running my numbers assuming that I was going to get 4 bedroom tenants in there. Like I need in DC, you get a 4 bedroom, you're renting it out to anybody. You can rent anything, anywhere to anybody.
Mhm.
And everybody told me, they were like, well, Chicago is quite different. If they have a 4 bedroom voucher, they're going to go get a house. They're not going to want to live in your apartment building. You're going to have 2 bedroom vouchers in there. So that brought my numbers down. And then they were like, the top levels, nobody's going to want to do all those steps because it was like a tall building. They were like, those are going to stay empty longer. So I had to increase my vacancy rates. And by the time I started adjusting all of my assumptions that I had made from my DC model to the Chicago model, uh, I was like, all right, I got to. So I wound up selling it as soon as I got my permits, which took 10 months to get because the architect that I picked wasn't even that great. They kept on getting rejected by the city.
Wow.
Yeah.
This was actually a whole lesson in number one, like what not to do, but actually what to do. And so in all caps, I wrote down infrastructure.
Yeah.
Also wrote experience. And so speak to that. Like that's, I would think like we have people that are listening and watching this, Russ, that are getting into real estate investment, that may be landlords. I'm a landlord, and to be quite honest with you, I I loved it when I started. Then I went cold on it for a while where I'm just like, man, I hate this. And then I'm back to loving it again, right?
Hmm.
And so speak to and I agree with you. Like every time that I've had an infrastructure and people that I can trust, things went well. But when I didn't have a relationship or someone that I could put to help me with certain things, that's when it kind of went sideways. Can you speak to infrastructure, like what you meant by that, and like also talk about why it's important to have experience?
Yeah, for sure. So one of the things that I've really learned, you probably don't know this about me, Shawn, but I used to be a party promoter too.
I do know that about
Oh,
you.
you did know that?
Yeah,
Okay.
I did too.
All right. I used to deny it like crazy. I was like,
Yeah, me too. I was behind the scenes guy, like,
yeah,
but whatever. It is what it is. But yes, I do know that you used to be a party promoter.
yeah. But I donated all my money to charity, so that's why I felt like I was not a party promoter. But eventually, I got corrupted and started working for a club who hired me. But anyway, that's neither here nor there. But I would say that one of the big lessons I learned from being a party promoter and also applied it to real estate is that I was really good at networking back then. And I have no idea how I was good because I'm such an introvert now. Like I was like, I can't believe I used to go out 4 nights a week, you know. And the way that I would basically create my event is that I would go out 4 nights a week and I would go to the most popular clubs or lounges, whatever. And I would look for the two most interesting people that night. And I would not leave until I got their phone numbers and invited them to my thing. Cause I only did a once a month event, you know? And I was very successful with this. I mean, I would on a regular, like 8 to 10 new people I met that week, you know? And I thought I was really good at at my job because when people would come to my events, they knew exactly what they would get. Everybody was really cool. They were handpicked crowd. But even though it got really popular for a while, it had its limits because I was the limit on it, to be honest with you. Like I was the limit because that event could only go as far as I went, you know, as far as how many people I met. And so it took me a while to really realize that. And I know exactly where I get this from. It's my dad was always, if you can do it yourself. Like my mom is opposite. She's like, if I can do it, I mean, you got to do it, you know? And I hated that as a kid growing up, you know, because she was one of those moms like, hey, come get my remote control. And it's like right beside her and I'm all the way upstairs. But that's really the one of the major, if not the most major keys to success is being able to duplicate yourself and create an infrastructure where things keep going if you're not in that equation. And when I first started in real estate here in DC, I was very much that one person doing everything. You know, I thought it was a good idea for me to learn how to bang a hammer. You know, I was like, oh, I'm gonna have to, you know, get on YouTube and learn how to do some electrical work and all this stuff. You know, and luckily, uh, I got out of that really quickly because what wound up happening to me is that when I bought my first two apartment buildings, I had all these plans. I was like, all right, I'm going to do this one on the next one, this one. But and the whole time I was going kind of slower, the market was going fast. It was going up. And so what I was planning on doing, thinking that the market was going to stay the way it was becoming more and more obsolete. So you got to be able to go with pace in terms of everything that you're doing so that you can move and react to the market quickly. And so that's kind of going back to your question about infrastructure. Why that's so important? Because if I'm going to be doing stuff now in Baltimore, or if it would have been successful for me in Chicago, there's no way that I could keep what's going on here, there, and there all together when it's me like being with my hand. Everybody's waiting on my decision or my hand to make a move before things keep rolling.
Got it. Got it. Yeah, that makes a lot of sense. And so speaking of which, that let's get into it, man. You have some models that
Okay.
that you use to help people, like for instance myself. And it was funny. I should have told that story because You remember when we just we did you had a mastermind, your broker a few months ago, and you did your presentation and you pulled up a few websites and you like, well, let's get a volunteer. And so, and I threw an address out there, and and then you started plugging the information into this whatever this website was in DC to kind of tell you some information about the particular property and such. I didn't tell you that that was my property until later. And then so I was like, you know what, man, like this dude knows exactly what he's doing. He knows exactly what it is, and you actually made me money that day because I had no idea the kind of situation that that particular property was in. You remember you looked it up, it was a 2-unit, and you told me that whoever owns this property, which in the back of my mind, I was like, yes, that's me actually. Like it could go up and like in height, like
Yeah.
building on it, and like you can actually push back on the property line and stuff like that if you wanted to do some construction on it. And so I felt like I'm like, you know, other people need to hear this. This is great information. But you also spent a good deal of time going through the model to give us an idea of how you would treat someone when they come to you to help them understand what's realistic versus what's not realistic. And so I'd like to get into that model if we can.
Okay, cool. We're gonna put your property on air. Everybody know where you live at now.
We're going. Let's go with the spreadsheet you had. You had one Katana and the other one. Which one should I pull up first?
We can start with the rentals first. That one's a little bit more straightforward.
Okay.
And so while you're doing that, I'll just talk a little bit about what you're just talking about. And so what the important thing about what you just said is a lot of people when they think about real property in the city, they just look at structures or land and say, okay, this is real estate in DC, you know. But there's a lot of real property here that you can't see. And so Shawn didn't realize that, you know, I'm assuming his structure of his house or wherever his place of residence was probably about 35 or maybe it was even 25 feet tall. And we looked it up on the DC zoning maps, and we saw that he actually had the right to build his property up to 50 feet, which is actual real property. That is all his right. He owns an invisible amount of property that has yet to be built above his unit. So the city, if somebody else who didn't have the same zoning as Shawn did, came to the city and said, "Hey, I want to increase the height of my property up to 50 feet," they would look at the zoning map and say, "Look, you don't have the right according to this, because zoning is made to make neighborhoods look uniform. They don't want a store sitting next to a house next to a farm. You know, they don't want one house 60 feet, the next house 20 feet, and the city looking disjointed." So if you happen to live in a neighborhood where you have these type of rights like Shawn has, you know, it's important to know what you have, because I mean, that is, if Shawn was to go and try to sell this, and I've seen this happen before, if he was to try to go sell this and he was working with an inexperienced realtor who didn't even look that up, the person on the other side is going to know what he's buying more than you know what you're selling. You know, so you're thinking you're getting a good deal, and they're laughing at you like, "Oh, this sucker." And I've seen that happen so many times.
Yeah, I can't imagine. Like I've had people find where I live and ring my doorbell
Hmm.
to try to buy that particular property. Phone ringing off the hook. And the funny thing is we renovated it recently and I took my kids over there and my daughter had never seen it. So she's like, "Oh, this is the property that everybody wants to buy, huh, Dad?" and and she's like, "Oh, I see why." Because it was, you know, it was 2 units, it was freshly renovated, but yeah, everybody wanted that particular property. Everybody was calling, they were texting, and I mean they do that anyway. But like I had, you know, people find where I physically lived and rang the doorbell to ask me if they could purchase the property.
Yeah, yeah, and multi units are the flavor of the year. I mean, for a while it was just single family house row houses in Columbia Heights, Petworth. People were taking these houses, throwing an extra level, sometimes extra 2 levels on top of it, and turning them into 2 or 3 condos. But then the city kind of clamped down on that, like 2016, between 2016ish, and they made it so that not everybody can go up 40 feet anymore. And And then that really kind of like put a little buzzkill on that whole strategy and model. So then everybody kind of switched over to multi-units now. And so you're sitting on a gold mine, not only what you already have, but the potential of what your property can be.
Hey, thanks for that, brother. I appreciate it.
Mhm.
Let's get into this model. So
Yeah.
you
So
drive, you talk, and then I'll work through
yeah,
it.
yeah.
You do mouse
So,
click.
so just like what we talked about at the beginning, when somebody comes to me and says, "Hey, I want to invest in, I want to buy and hold," and so what I said is I always start with them, which is that very bottom number on there. ROI, how much, what return do you want to make on your money? Right. So just like where I start with there and work backwards on this spreadsheet right here, you can see the bottom says this person is going to make 18% on this rental property. All right. So the way that I kind of figure out each one of these, so this is a spreadsheet. So this is all formulas. So I find properties on the market and or off market, and I basically plug in all of their particulars and financials into this spreadsheet. So the reason why the first line is important, how many bedrooms it is because usually in DC, especially using a voucher program, and this is the beauty of DC. This is a big factor of why a lot of people would like to invest here, because when you're trying to make a decision, and I had this problem in Chicago. This is one of the main reasons why my whole formulas blew up, is because I had to guess how much I'll be making in revenue, and I had to guess how much I have to make in terms of uh, how much my cost would be. In DC, you only have to guess what your cost would be, because there's a website. If you could click on the link that starts with DC Housing, if you click on this website, it will tell you how much you can rent out each property in DC in every neighborhood based off of how many bedrooms it has, if you're open to using the voucher program, which of course I am, and which of course I encourage all of my clients to do. A lot of times, people, well, in the past, a lot of times people were very against the voucher program because it has a certain stigma to it. But that is changing rapidly. I mean, everybody I talk to now is like, yes, I want a voucher tenant. And then it just makes more sense. I mean, it's a government contract essentially. And so once we pull up this website, I'll show you. I'll kind of show you how it works. And I mean, once you get this, you don't have to guess anymore in terms of what your revenue is, the number is going to be, because that's the amount you're going to get to the dollar. And so when I first started in this industry, and they told me that, I was like, okay, this can't be this direct and straightforward. And they were like, yeah, it was that way. And I just knew that I was making some type of mistake or error that I was overlooking. And I mean, this thing is like a crystal ball. Hey, you do your job, and this is how much revenue you'll get every month.
Got it. Yep. I'm gonna share the screen in 2 seconds.
And I was trying to talk to you, got it up, try to see what this teamwork.
you're good, man.
But so while you getting that up, I'll talk a little bit more about the voucher program, even though that's not what we're here to talk about today. Um, the voucher program, yeah, that's it right there on the left. And so you see that area where it says select neighborhood, and there's a little arrow pointing down. If you could click on that, it's to the right, yep, right there. And so all you have to do is any neighborhood in DC, you can go in there, and let's go to Deanwood, my favorite neighborhood.
Where are you, Deanwood? There we are.
Yep. So this says there's two columns. There's one with utilities and one without utilities. And so I always encourage my clients to do without utilities. So with utilities means you're going to rent it to the client, and you're going to pay all of the utilities for them. All they don't have to do anything. You're taking care of everything. They just pay one. But I don't like that, because a lot of times when somebody else is paying the bill, people take advantage of that. They might have the heat on and the window open. So I'm always on this right category here, without utilities. So this will tell you if you have an efficiency, which is that first line 0, they will pay you $11.65 a month. You have a 1 bedroom, they'll pay you $12.51 a month. Oh, and so on and so on. And this actually goes on past 5. So if you have a 6 bedroom, 7 bedroom, it's just not listed here, but it'll tell you how much money you can make depending on how many bedrooms, and that's the only factor. Whereas a lot of cities where they have the voucher program, that this number varies. So they might say, here's the suggested price of what we would pay for a 3 bedroom. Then they might come and look at your unit and say, it doesn't have a washer dryer, it doesn't have central air, and they start knocking off of that price lower and lower. Doesn't work that way in DC. In DC, what you see is what you get. So this is the website where it doesn't look like it's going to be easy to bounce back and forth between this and the spreadsheet, I'm guessing, right?
Yeah, it's gonna be it's gonna be a little difficult, but hang on, let me see what I can do.
All right, so I'm just gonna stick to the spreadsheet then after this one.
Okay.
Well, actually, yeah, go ahead.
Yeah, I'm gonna go back to the spreadsheet. I've my 2 units in Randall Heights.
Yeah.
And it's always I've always had the voucher program.
In Randall Heights, it's unexplainable. I cannot figure this out. Why Randall Heights has such high rental rates? That's one of the best areas to have rentals. They pay a ton of money over there for the voucher program.
Mm-hmm.
So I don't remember which property this is. If you scroll up a little bit, I can see what property this was. This is Brandywine Street. So yeah, this one actually, if anybody's interested, this one is still for sale. But this was a 5-bedroom condo on Brandywine Street, and the rent on this one is one of the rare occasions I actually did encourage the landlord to pay the utilities, because the condo fee paid most of the utilities except for the gas. So that's the rate that I got off of the website for Congress Heights. It's $26.44. That's how much they'll pay for a 5-bedroom. So, and it's very neighborhood dependent. If you take a 5-bedroom and put it in somewhere like Brooklyn, that number is probably going to be closer to $5 or $6 grand. But so that's where I just plug that number in. For the management, I just assume they're going to have a property manager, especially if they're not really investors like that. And so that's 10% of that revenue number. Condo fee comes right off of, the listing, or if it's off market, that's easily to find out. Ask the owner, what was the condo fee? For gas, that was an assumption, because that's the only utility that this place had to pay. And the heat was gas now. And so I assumed they were going to be using it half of the year. So I just average that out. And I usually make my my cost assumptions pretty high, just in case, because I always like to, I never like to undershoot in terms of what the return is going to be. So I like to put my cost a little bit on the higher side. For insurance, I assume, since this is a condo, I only have $50 a month, because your condo fee covers most of your insurance, your main insurance. And for vacancy, that's what a lot of people leave out of their models, I find. They assume that their units are going to be occupied 100% of the time. And so they don't add any factors in here that, hey, the tenant might move out and be gone for, 2 months out of 24 or 3 months out of 24. So you need to, and that actually, if you average out over a long period of time, how much money you actually made, considering that your unit was empty for 4 months out of every 24, you might think you're making $26.44 a month, but when it comes down to it, or whatever the profit is, on this one, the profit is $700 a month. You might think you're making $700 a month, but well, actually, in this scenario, you might think you're making $900 a month, but once you add those vacancy things in there, you're actually making $700 a month. Because if you didn't have this vacancy number, you would think that you were making $832. That's 700 plus 132 would be what you thought you were making. So lawn didn't, usually if it's a house, I'll put this in, but this is a condo, so there was no lawn. And usually you can get somebody, unless the house is really big, you can get somebody to do the lawn for like $40, a month. Taxes, that comes off the DC public records. We won't go into that because it's going to make this too long. Miscellaneous is just for little stuff here and there. DCRA asking for register your property. All these things are little fines that you're going to pay throughout the year. So $25 a month should pretty much cover that. As for mortgage, I get this off of and normally I would just, if I was doing a screen share, I would do it, but don't worry about it. You can go to Zillow mortgage calculator, and you can just plug the number in of what the mortgage would be, and they're going to break down how much your monthly payment would be, principal and interest, and you would just plug this number in here. The other numbers that they're going to have in there, like taxes and all that stuff, are already included, so don't double count that. And then that gives you your total cost right at the bottom where it says sum. And then the 2644 minus that 19 is $700. That's how much she would have been making if she would have bought this property. She didn't buy this property. Her down payment was $47,800. Can you click on that? Okay, you can't click on that. She was doing well. I thought it was going to be a formula in there, but that number right there assumed that she was just going to put 20% down, and she's going to do about $20,000 worth of work. This condo needed work. Closing costs are generally going to be about 3% of the cost of any property in DC, ballpark. And so with that being said, her ROI is going to be 18%, which is really good for DC. And the reason why that is, going back to what we talked about before, the reason why that number is so high is because it's a condo, and condos don't appreciate as fast as regular houses in DC. And it's also in a neighborhood, Congress Heights, which is not as sought after as stuff that's in wards 1 through 7 sometimes, even though it's one of my favorite neighborhoods. And so that's why this one gave a huge appreciation amount. A huge ROI, because it sacrificed the appreciation that you would normally get from properties. So that's basically how to break down a rental property.
Got it. So the tools, what we're going to do is we're going to put the tools in the comments so folks can have them. But the biggest one is number one, the voucher program. You can actually go and look in the link that we're going to include for DC Housing Authority, and look for the neighborhood where your property is located, and it'll give you an idea of what the rents will be. And those are firm numbers. It's not an up to number. It's an exact number based on the number of bedrooms you have. Is that right, Russ?
That is correct.
Okay. And then the other tool that you would use in this particular situation, if you're running a model like this, would be a mortgage calculator. So you can just go and just look it up, find a mortgage calculator, Redfin, Zillow, my website, fortismortgage.com.
That'd be the best way to go.
Wherever you would like to go. It doesn't matter. Wherever you would like to go to use that. And then also we had a link, but we didn't show it. You can look up the property taxes. So no matter where you're located, I recommend always to type the city that where you're going to be purchasing, plus real property taxes. So the way I would find the site, obviously we have a direct link for DC, but I would just type DC real property tax lookup, and that's how I would get to the zoning section. What else we got? I see the zoning map thing that you put in here. Is that the resource you were using when we were looking up my stuff?
Yeah, so we can do that. We can go through that one.
Would you rather go through that one or go through the other models?
Let's do it. I don't even know how much time we have here, but let's do that one.
Got you. We have time. It's just, I want to respect your day too as well.
Yeah, no, I'm good.
Hang on one second.
Hey, Sharnice. I see Sharnice is on here.
Yeah, she is. All right.
Sharnice, by the way, is my broker. And so, while you're doing that, I'll talk a little bit. So when I decided I was going to get into real estate, being a agent part of it, coming out of the investment side, she really showed me the lay of the land. I was coming out of another brokerage, which was famous for their training, but they take a crap ton of your money off of every commission in exchange for that training. So I was there for about 2 months, and I was like, all right, I think my first commission check was $17,000. I did my little calculation. I was like, all right, my first commission check would be $17,500. And then when I finally got my check, after they took all their money out, it was $11,000. I was like, all right, where's the exit? And I wound up calling up, looking up, brokerages that gave you 100% of your commission. And I found Realty One Group, which I had never heard of before, but I like their website, I like the branding. And then I talked to Sharnice, and I was like, all right, well, I'm going to be sacrificing my training here because they're not taking any of my money, so I'm sure they're not going to train me anything. But I wound up learning more through Sharnice than I did through that more expensive broker. So that was the gods looking out for me there.
Oh, no question. Sharnice is a vet too. She's
Oh
been
yeah,
in the industry for 20 years now, almost.
yeah,
Since she was 2, and yeah, she cares. And I don't know how she does it, but she finds the time to to work her own personal book of business, but also pour into the folks that's in her community and on her team. And so no, that's really good. I'm glad for her that y'all got connected.
yeah. I mean, speaking of that, she did almost 20 million in sales this year, all while training these newbie agents who she's like, some of them don't even have the drive, but she still is like pulling them up. I don't know how she does. She's crazy.
Yeah.
She must be a workaholic. Yeah.
So let's get to it. Tell us what this tool is. This was my, out of everything you did, obviously for selfish reasons, Russ. This was my favorite tool.
Yep. All right. So is that your ad? Oh, okay. Oh, you pulled up.
Oh,
All
this
right.
was one
So
that was already in here. You give me
okay,
an
got
address. I'll put it in there.
I
I can
got
put mine in there. It
no,
doesn't matter.
no, no. I'm not gonna put your. Okay. Well, let's look at your property there. So
Um, should I or should I not do
no, let's put we'll put, let's see, let's pick a random address.
Hey, you know what? I got one.
All right.
18. Here we go.
Okay, so basically, what I think we might have skipped one quick little step. So basically, to get to this website, this is DC zoning maps. So you can Google that, and then once you get there, there's going to be something that's going to say interactive maps. So once you get there, okay, there's the links right there. Once you get to that website, you can get to where we are now, where you could just plug in right where he was there, where it says address, and figure out, look up the property that you're interested in. So he's done a search already for 1817 18th Street Southeast. And so you can kind of see on the left side, they actually have a picture of it. And what that is on the right side here is what the lot size looks like compared to the neighborhood. And I don't know if you can see this or not, but in red, there's something that says RA2, and it's labeled on, yep, right there, RA2. And then as you can see, if you go across the street there on whatever street, T Street, I guess that is. Once you go to the other side of the street, the zoning changes to R2. And this goes back to what I was talking about earlier about how the city wants everything to look uniform from block to block, so they might not allow you to do everything you want to do if it doesn't look like your neighbor's stuff. So the most important thing on this sheet right now, besides seeing the owner's name, is that zone district RA2, which we just talked about. So if you go to the left and click on that RA2, that's a hyperlink which says zone. Yep. If you click on that, it's going to give you a description of what a RA2 property can do. All right. So it might be a little bit small for people, but it says it permits flexibility of design by permitting all types of urban residential development if they conform to height, density, and area. So basically, is what I'm saying. It has to conform to your neighbors' houses in terms of the height, density. When they say density, is like how much of your land are you taking up, and so it says permit the construction of those institutional semi-public buildings that will be compatible with adjoining residential uses and that are excluded from more restricted residential zones. So basically, the most important part here is this chart that's right below that. And so where it says floor area ratio, that's a whole formula that you can calculate which tells you how much. So once you look at the square footage of your property, how much can you put on that? And when I say the square footage of your property, I'm talking about your lot size, not the actual structure itself. So the floor area ratio basically says how dense can that property, the structure be on top of that lot, right? And the next section is exactly what we were talking about uh, when we were talking about rights that you can't see. So this property has the right, and I don't know how tall it is currently because we could probably look at it in Google Maps and make a guesstimate. But let's say that this property is about 30 feet tall. This says that by right, you don't have to ask the city, can you do it? You have to get permits to do it, but you don't have to ask the city, can you do it? But you can extend this building and make it tall enough so that it takes up every single bit of that 50 feet that they allow you. So that's essentially like saying, here's extra land in DC for free that you didn't even know you had. The land that you own is in the air. It's not on the ground, which we're traditionally used to seeing, but that is land that you own. It's just invisible to most people. And
right. So it would be like, Russ, this building right here where I have my mouse going.
Yeah.
Like how this is higher than this particular building. Like you see this apartment building on the left-hand side.
Yep. Exactly.
So I can keep going up like this particular building.
Exactly. But that one may be already close to that 50 feet.
Okay.
Yeah. Because 1, 2, 3. Yeah, no, that one might have some room to go up. So they start counting from the ground level, and I see that that one has 3 floors above ground level. There's some tricks that people use, but that I'm gonna share here because the city measures from the ground level how tall your property is. What some people wind up doing is they in their front yard they'll pack a bunch of dirt and lift that dirt up higher. So when you start counting, you're starting to count from right here versus if you didn't have that dirt, it'll be maybe like another 2 feet below or so. So yeah. So I think the thing went away. But anyway, so this website tells you everything that you can do with your property, right? But it gives you your restrictions too. You see how it says side yard, how many feet? So you have to be at least 8 feet. You can't build your place. So let's say your fence is on the left side of your house. You can't build that house where it's less than 8 feet away from the left side of the house. It has to have at least 8 feet of side yard on both sides, and the backyard has to have at least 15 feet from the back of the house to the alley or the end of your property line. So this is a really the kind of like the guide and tool in terms of what you can and cannot do with a property. So this is how you unlock value, because the name of the game in real estate is not looking at what you're buying. It's looking at what is the highest and best use. What is the potential of a property? And that's what a flip is essentially. You're like, hey, this property is dilapidated now, but I'm going to make it look like this in the end. And this just gives you a tool to see what all you can do besides changing out the toilets and the sinks and the showers. What else can you do? Can you add more to the top? Can you take something back? So that's pretty much the whole synopsis on that website right there.
Hey man, that's awesome. Wow, if you're getting some value out of this, put an exclamation point in the comments. Make some comments in there. You know, this replay is going to be awesome because Russ is giving us tons and tons of gems and information, and we'll make sure that we put the links in here as well. So when folks see the replay, they will have these links. We're gonna have to do a master class, Russ. We're gonna have to pull together a master class and get people in because there's so much information. And I typically allocate anywhere between 30 to 45 minutes to do this, and it's mostly out of respect for your time. I have the rest of the day because Thursdays are typically my favorite work day because I get to have these conversations with people all day. So I block off my entire day, and the only the only appointment that I book on my calendar is this particular live stream. So we do still have some time, but just like I said, out of respect for your time, we can move on. Um,
We can go on because I think we're gonna go over a flip real quick.
okay, cool. So that's Quintana.
Mm-hmm.
All right, let's do that one. Share. Thank you for this too, sir.
Yeah, my pleasure.
I got you in your element now. Superpower. Ready? Here we go. Gonna share this. And by trade, are you an accountant? I think, right? Like from schooling, I should say.
Yeah, it's funny you said that because accounting is actually the least favorite part of my job. I hate that part. Um, but no, I went to school for finance and economics at
Okay. All
University
right.
of Florida. Yeah,
Okay. So this is actually what your schooling gave you
yeah,
is the
yeah, yeah,
ability to think this
yeah,
way.
yeah, exactly.
All right, here we go.
All right, if you could blow that up a little bit. Um, I mean, I can see it. I don't know if everybody else can see it. But so this is a little rule of thumb spreadsheet that I use. And this one will get you because a lot of times when people do flips or look at the potential of doing a flip, they might say, okay, I can buy this property for 160,000 and you can sell it for 380. That sounds like a great deal. I mean, right there, it just sounds like, man, I'm going to make $200,000, somewhere close to it. It only needs 50 grand worth of work. So, I should make like $150,000. But money can get sucked up so quickly throughout a deal. And a lot of times it's, oh, my guy Chris is on here. And money can get sucked up throughout a deal. And it's invisible a lot of times at the beginning because you can't really see it. And so this kind of tells you where all the money might get ciphered into. And so if you really want to kind of be real tight on your numbers, you can make adjustments in each little category. So everything that's highlighted in yellow on the spreadsheet are more like the variables where you can change them out, and everything else kind of spits out based off of that. So on this particular example, you can start on D31, and that's the purchase price. This is how much you're buying it for. And if you look up a little bit to D24, that's how much you're going to sell it for. So it's the exact example of what I said. You're buying something for 160, selling it for 380. All
How you
right.
come
So
up with that number?
which one? The purchase price is whatever they're selling for. The estimated sales, you're going to run what's called comps or comparables to
Yep.
try to figure out what the after repair value is. And so all that is you're looking for similar or like houses that are already renovated, and you're figuring out what they sold for, and then you kind of back that in and say, okay, the house that I'm doing is going to have this, this, and this that house had, but it's not going to have this and this and this. And then you kind of adjust your numbers based off of that to come up with your estimated sales number.
Thanks. For those that are listening, that's a part of your budget.
Yep, exactly. And so under purchase price, that's the purchase price. But a lot of people might neglect the fact that there's a lot of closing costs that goes along with that. So right there, for some reason, there's no formulas in the one this one for some reason. But normally, what that is going to be the purchase price times 4%. Now, the rule of thumb is your closing costs are usually 3% of your purchase price. But I always like to estimate everything a little bit higher on the cost side because I don't know, it's rare that you come up with your budget for costs and it comes right on that number. So I try to always assume higher than what I think the number actually will be. And so on the next one, that basically adds the purchase price plus the settlement cost. And so is that 4%? Yeah.
I put 4% in
Yeah.
here. Is this
Perfect.
number? Is that what it
Yep.
is?
Yeah,
Purchase price
right.
times 4%.
Yep, exactly.
Okay.
Yep. And so total cost is 166. So that number automatically populates up to B3. So that's our real starting point. All right. And so after that, and also, by the way, that what's not accounted for in here is going to be accounted for over here on the left side where we have what's called points and interest. But you know what? This one actually, for some reason, this maybe is not the best one to go through because I see there's no points in here, but that's all right. We can add points in here. So normally your purchase price is going to be a little bit higher because hard money lenders or private lenders, they usually charge what's called points. So points are just a fee that they charge you just for even giving you a loan, which might sound a little bit crazy to you guys, but yeah, I mean, hard money lenders, what you guys may have heard of, they're taking more risk than the average bank. Most banks don't like to give you a loan for doing flips because they know that you're only going to hold this loan for 6 months or less. And lenders, I guess you could speak on this, Shawn. Lenders do not like holding a loan for less than 6 months, right?
Oh yeah, we want to hold the loan for longer. Yeah, lenders want to always hold the loan for a longer periods of time because
Yeah,
that's how lenders make money is by keeping the loans and receiving the interest that is paid over a 30-year period.
yeah, exactly. So if you tell your lender, "Hey, I'm actually planning on flipping," a lot of them probably would deny you on the loan by itself, right? And so usually if you're doing a flip, you're either going to be in finance either cash, you're going to have a private lender or hard money lender, or you're going to have a commercial bank who's giving you the money on this. And so with all of those, besides the cash, your interest rates and the points are going to be higher because they're taking more risk and they know that banks won't give you that money, so they can kind of dictate the market a little bit more. But given that the fact that we're in Washington, D.C., and it's such a competitive market, a lot of lenders really want a loan in D.C. because we have a lot of insulation from downside risks. And so the hard money lenders have been competing with each other. And it used to be when I first got in the industry that um, they would charge 5 points and 15% interest for a hard money loan. So if you're doing $100,000 loan and you keep that loan for a year, you have to pay $5,000 right off the bat just to get the loan, and then you'll pay 15% interest, so $15,000 over the course of a year. So that's $20,000 just to borrow. $20,000 you have to pay the lender back just to borrow $100,000 from in the beginning. And so because, like I said, because the market is so competitive here, now that number has come down to about 2 points and 9% interest. But if you're planning on holding this property for longer or want it to be a rental, you can talk to Shawn. Shawn will finance that all day. But I'm pretty sure, if you go to Shawn and say, "Hey, I want a 3-month loan," he's not gonna call you back. Or
Yeah, we have actually. I had someone on here previously. We have a line of credit option that we can do that will it'll be similar. It's an alternative to hard money lending where
uh-huh.
you can get access to a line of credit. They earmark the money to do these types of short term
Yeah.
financing. So anywhere between 12 to 18 months on a repayment. But yeah, if we were looking to do a standard agency loan like Fannie or Freddie or something like that, and you tell me that you're going to flip it and not hold the loan for 6 months, and we have to pivot and have a different conversation because that's going to be more of a commercial loan for someone.
Well, and lines of credit are really, really hard to come by. So I'm impressed that you guys are offering that. It took me a couple of years to find a bank that was willing to give me a line of credit, and some reason a lot of banks don't like to do that. Uh, but
Yeah,
they,
we do definitely have access to it. And then like even on some property like this, for instance, Russ, say someone falls in love with the property and they decide, hey, I want to turn it into a an investment property because I looked on the DC housing voucher program and they're paying, $2,000 a month for my neighborhood for a 1 unit or a 2 unit. And I
yeah,
feel like I can get more cash flow and then ride it out to get better appreciation value in the future. We can then take this hard money loan or this private loan and through the line of credit and flip it into a permanent loan. Do a 30-year fix. You can do. There's no arms, but I think there's a 30-year fixed option. Well, I know there's a 30-year fixed option. I'm not quite sure if they have arm or not, and you can convert that into a permanent loan.
that's excellent. That's like gold because that's hard to find.
Yeah,
Uh,
and it's no. I mean, you need assets and a credit score, and then you do it in your business name. There's a personal guarantor or guarantee, but you don't have to provide like any income documentation, which lots of times, especially like folks that run businesses and such and that are investors, tend to write off a lot of their income. And So even when trying to qualify for a traditional mortgage, it doesn't really work out in their favor because they don't show enough income because they're writing down all the costs associated for doing business.
Yeah, yeah, that's excellent. So I'm about to get some out of this. So I'm glad you told me that. Yeah.
Yeah. It's and even like we're doing a 13 unit right now, commercial property, and it's working the same way, similar way. The guy's been turned down by 2 banks so far, but we're able to work with them to get this 13 unit financed, just based on the product that we have.
Nice, nice, nice. So going back to the yellows, so in B4, renovation total, I usually figure out and so this is going to probably be the hardest part for most people, if you haven't been doing this for a while, or if you don't have a construction crew. So I know ballpark how much my crew charges for each individual thing, how much it'll cost, because if you're going to try to figure it out yourself, I would say the way to learn how much stuff costs is going to Home Depot's website and looking up how much does drywall cost. Home Depot actually has a really good tool on their website where you can put the square footage of the property or the room, and it'll tell you exactly how many pieces of drywall you need. And you could also do that with 2x4s. But the best way to figure out what the labor will cost is typically, and these numbers are probably gone up for most people, but I've had my crew for years now. But usually like an unskilled worker, somebody who does mostly the demo, who does all the carrying of the buckets and everything for the crew, they're going to make like between $110 to $130 a day. A mid-skilled guy who's can do some electric work, on a smaller scale, who can do some tile work, they're going to make somewhere between like 150, 175, maybe 185 a day. And then your top guy who can do it all, or who's managing everybody, is going to make somewhere between 225 to 250. That number is probably up to closer to 275, 300 now, because contractors are in super demand right now. And so if you take that and then you try to figure out how long does it take for them to change the tile on the floor, and then you can kind of add those numbers up, say, okay, it's going to be the mid-skill guy and the labor guy working for 2 days straight on that 8 hours a day. And you multiply 16 times, their daily rate, or their hourly rate. And then that's how you could kind of ballpark in terms of figuring out how much the labor is going to cost. So that's probably going to be the hardest part for people to figure out, what's your renovation total. But if you don't want to go through all of that, what a lot of people do is they might ask contractors or find out what is the average price per square foot of construction in DC. And right now, if you look that up, that number is going to be somewhere around probably 175, between 150 and $200 a square foot, which is really, really high. This is really high. So, if you have if you have 1,000 square foot home, theoretically that should cost you $200,000 to fix if you're building it at $200 a square foot. I think I'm closer to like $80 a square foot in terms of just doing small renovations like this. But that number is going to change if you're doing like a ground up construction and like changing the foundation and all that stuff. But anyway, that's the rule of thumb to figure out, is how much do the contractor you plan on working with, you could just ask them how much do they think they'll charge per square foot, and then you can multiply that number times whatever square footage of your property is.
What's the best part of this thing that for you jumps off the page, Russ? What are you looking for?
So it's going to be down to that profit number, which is B18. And actually, the more important number is right below that, is your percentage return, because you don't want to make $107,000 if you put $2 million up. So what you want to look at is how much of your money are you getting back. So that 42% is based off, you made $107,000 based off of a 246,400, which is B8, off of a $246,000 investment. So this, of course, is a really, really slam dunk deal, and you're not going to find a whole bunch like this in DC these days because the inventory is just so tight right now. So, but yeah, that's the most important thing I would say.
Got it. Got it. So here you have the cost to purchase. That's what this
Yeah,
subtotal
yeah,
is. So that's your purchase price plus your closing cost plus your renovation,
yeah,
and then the points and fees
yeah,
along and the interest that you pay over 6 months
yeah.
uh equals
Portion
this
not
number.
in there but for
You're
some
gonna
reason. Yeah, but
uh,
normally
oh,
there'll be there.
and then you're gonna sell it and net
Yeah,
about 360 from that sale.
yeah,
And then what's left over is $107,000.
yeah. Yeah,
Yeah,
and the sale that 360 comes from line D24, where you basically have to pay your agent, you got to pay closing costs and everything, and then after that, that's the net amount that you actually wind up getting.
got it, got it. All right, we're gonna shut this down because I'm gonna have to put a well, I've seen some people put cash apps and stuff like that. I'm just kidding, but there's been a lot of good information. Um, a ton. I mean, did you have something else on that particular spreadsheet? Because I can push it back. Did you have something else you wanted to go
No,
over on that
no,
spreadsheet?
that's good. Now, I'm going to send you another one. For some reason, the one that I sent you just there didn't have the formulas in it, but usually all the formulas will be plugged in already. You change one thing, everything else changes.
Yeah, I was trying to do it on the fly just now.
That's
But I will get it programmed. That's why I asked you earlier, was it proprietary? If it's something that I could have, because I could use a spreadsheet like this. This is good stuff.
Yeah.
Hey Russ, what do you need from us, man? Like or just in general, like what can we do to help you?
To be honest, that's an interesting question because what I found in, especially from being a realtor, is if you give without expecting anything back, for some reason, man, it comes back four times. I really didn't come on here with any expectations of anything. But if anybody needs any help with anything, trying to evaluate a deal, they can feel free to hit me up. When I first got started in this industry, I didn't know what I was doing, and I was asking everybody and anybody who would listen to me questions, and everybody was willing to share all of their secrets. And I can't help those people out because they're all millionaires. So the only way you can help them out is by paying it forward, just like they did with me. So not a problem.
And how do we connect with you? What's the best way to connect? How do we find you?
I'm on Instagram at Russ_Brown. That's pretty easy. RUSS_Brown. And my email is Russ@RFB List, stands for Russ Foster Brown. And should I put my number on here? I don't know. Yeah, I guess I can put my number on here. Is that a bad idea?
Yeah, we're gonna put it in the comment section. What is if you want to give us your phone number too, how can they connect with you?
Yeah. All right. Cool.
That's up
My
to you though, because if you want to put it on there.
All right. Yeah, I'll put my number on there. My number is 202-256-5964. Again, 202-256-5964. And yeah, hit me up. Hit me up.
That's awesome. So look, before I let you get away from us, one last question and then we'll be out of here. So Russ, you get one person, you get to ask them one question. Who would it be and what would you ask?
Oh man. Oh man. And I seen you do this on other shows, so I really should be prepared. I'm gonna have to go with Martin Luther King.
All right.
And my question would be, if you could see where we are now, would you change anything that you did leading up to your death?
Huh. If you can see where we are now, would you
Was
change?
it worth it? Was it worth it?
Wow. Yeah, we've had Martin Luther King. We haven't had that question though. We haven't had it framed that way.
Yeah.
Um,
I mean, because he gave up. He gave up. He knew he was giving up his life.
everything.
Everything. And would he? My guess. I have a guess on his answer. My guess is that he was such an optimist that he would look at the good in us and what we've done, and be able to put it all in context. Because the trajectory is where it needs to be. It's just not quite there.
Right. I was talking to someone yesterday, and it when I talked to him, I didn't realize until he said it, Russ. He said that he's been uh, dedicating and devoting his life to helping people
Hmm.
that are suffering or need help in some way, shape, or form. And so when it doesn't work out, sometimes he feels like he's failed, right?
Hmm.
But he said he had someone reminding him that this is the business that you chose. So you chose the business of helping people that are suffering and that are helping people that need you. So that's what you get with it. So you also are going to suffer too as well.
Yes, yeah, you're right.
And you have to go through it with them as well. And when I heard that, it made a lot of sense, man. It just made a ton of sense.
The,
Uh,
the one way that you could possibly, this is easier said than done. The one way you could possibly uh, kind of get around this, but I don't think you can, is one thing that I've learned in terms of business, which is hugely powerful, is don't tie your success to the end result. Only tie your success in your mind, what success is, to your process. So, in other words, if you did everything that you said at the beginning of the day that you had to do in order to help people, and you checked off all your boxes, that's how you know you were successful. Not whether or not that person did whatever he did or not.
hey, that's Tanya Williams said powerful. I was gonna call it a mic drop, but hey, it would be such a shame, like I say every week, Russ, for me to have folks like yourself in the network and not be able to share them with everybody. So I really appreciate you coming on today and giving us this information and allowing us have a part of you today. So thank you for that. As I mentioned every week, is that if there's anything that I or we can do to help you in any way, those of you that are listening, please don't hesitate to reach out. We'll do whatever we can for you. Everybody still do your best to remain as safe and as healthy as possible, so we can get through this thing we're going through right now. And we'll see everybody next week. We'll be here at 2 o'clock next week. With some yoga next week. I got yoga next week, Russ.
All right, I'm gonna be there.
But thanks again for your time today, sir.
Okay, my pleasure.
All right.